All right, today we're tackling something that's on a lot of Canadian parents' minds, the Registered Education Savings Plan, or as you probably know it, the RESP. It is an incredibly powerful tool, and we're going to break it all down.
I mean, let's be real. The rising cost of education is on pretty much every parent's mind, right? It can feel a little overwhelming, but here's the thing. There's actually a government-backed plan designed specifically to help you save for it. And get this, it's not just about saving, it's about getting free money from the government to boost those savings. Seriously.
Okay, so here's what we're going to cover. We'll start with the basics of your education savings plan, then meet the key players. After that, we'll get into the exciting part, how your money grows. Then, what happens when it's time to pay for school, what to do if plans change, and finally, a few tips on avoiding some common mistakes.
All right, first things first. What is an RSP, really? I mean, it's way more than just a regular savings account.
Okay, so think of it like this. It's a special savings contract. It's between you, they call you the subscriber, and a financial institution, like your bank. And its whole purpose is to save for a future student's post-secondary education. But, and this is the key part, it's not just a box you put money into. It's a special box that comes with some major government perks.
Now, to really get how this all works, we need to meet the cast of characters. There are three main players in every RSEP story.
First up, we have the subscriber. That's you. You're the one who opens the plan and puts money into it. You're the driver of this whole thing. And it doesn't just have to be a parent. It could be a grandparent or another caregiver too.
Then there's the beneficiary. This is the future student. You know, the child or person you're saving all this money for. They just need to be a Canadian resident and have a social insurance number.
And rounding out our trio is the promoter. This is just the official term for your financial institution. So your bank, your credit union, whoever you open the RESP with. They're the ones who hold and administer the account for you.
So you can see how it all fits together, right? You, the saver, go to a financial institution and open a plan. You name the future student, you start making contributions, and the institution, the promoter, manages all the back-end stuff, the investments, the paperwork, and most importantly, getting those government grants for you.
Okay, now we get to the really good part. This is how your money grows, and honestly, this is where the RESP becomes a total game changer. It's not just about what you contribute. Your money gets, well, it gets supercharged.
Check this out. A huge part of this is the Canada Education Savings Grant, the CESG. For every dollar you put in, the government literally adds more. They'll match 20% of your contributions up to a certain amount. So you put in $100, they kick in an extra 20 for free. It's an incredible boost to your savings. So let's just recap the sources of growth here. You've got your own contributions, of course. Then you have the big one, the Canada Education Savings Grant. For some families, there's also something called the Canada Learning Bond. And depending on where you live, there might even be provincial grants. And the cherry on top? All of this, your money, the grant money, it all grows inside the plan, completely tax-sheltered.
Now, one thing to keep in mind is that an RSP does have a lifespan. You can contribute to it for up to 31 years from when you first open it, and the whole plan has to be wrapped up and closed after 35 years, so there is a clock on it.
All right, fast forward a bunch of years. Your child gets that acceptance letter. Awesome. So now what? How do you actually get the money out to pay for school?
Okay, this is super important. The money comes out in two separate streams. First, there's all the money you put in over the years, your contributions. That money comes back to you, the saver, and it's completely tax-free. It's your money back. Then you've got all the growth, the government grant money and the investment earnings. That part is paid out directly to the student. They call these educational assistance payments, or EAPs. And the great thing is, because the student is getting the money, it's taxed at their income level, which is usually very low, meaning they'll probably pay little to no tax on it. It's a really smart system.
Now, there is one little rule to know about right at the start of their studies. In the very first semester, or the first 13 weeks to be exact, there's a cap on how much of that grant and earnings money the student can take out. The current limit is $8,000. But after that initial period, that limit is gone.
Okay, let's tackle the big what if. It's probably the #1 question parents ask. What happens if my kid decides not to go to college or university? Does all that money just disappear?
No, definitely not. You have options, so don't panic. First off, any money the government put in, the grants, that has to go back. That makes sense. But your original contributions, they are always 100% yours to take back. And for all the investment growth, you've got a couple of choices.
So for the earnings, you can take them out in what's called an accumulated income payment, or an AIP. Now this gets taxed at your regular income tax rate plus an additional 20% tax, so it can be a bit steep. Your other main option, if the beneficiary happens to be eligible for the disability tax credit, is to roll those earnings tax-free into a registered disability savings plan, an RDSP.
But wait, there's a really smart way to soften that tax hit on the AIP. If you have RRSP contribution room, you can move up to $50,000 of those earnings directly into your RRSP. Look at this example with Mary. By transferring most of her AIP to her RRSP, she dramatically reduces the amount that gets hit with that extra 20% tax. It's a fantastic strategy to know about.
And finally, let's talk about a few rules. The government gives all these great benefits, right? So naturally, there are some pretty strict rules in place to make sure the plan isn't misused. You'll want to know these to avoid any costly mistakes.
This is a big one. If you hold what's called a prohibited or non-qualified investment in your RSEP, the penalty is, well, it's huge. We're talking a 50% tax on the value of that investment. Yeah, half. It's a mistake you really don't want to make. But here's the good news. You're not navigating this alone. The law, specifically the Income Tax Act, actually says that your promoter, your financial institution, has a legal duty of care. They have to be prudent and help you minimize the possibility of making a mistake like holding a non-qualified investment, so there's a safety net built in. So when you add it all up, the tax-free growth, the free money from government grants, the RSP is just a uniquely powerful tool. So now that you know how it all works, what's the first step you're going to take? You know what they say, the best time to plant a tree was 20 years ago. The second best time is right now.